Hello, Rahim. This is Aisha. Our last conversation was on a book where you have mentioned that I have to answer some situational interview questions. So, first of all, I want to share the document that you have shared with me. Uh, Let me share the document, and here it is. So, here is the document. The document is basically consists of two-part questions. The first part is a situational interview question. There are three questions in this in part one. I have to answer all these. The first part is a company that sells skincare products. They have purchased in January some raw material of $300. Then in February, the prices are basically went up. So they have spent 300 same $300 uh, by purchasing raw material, the quantity of which is 150 moisturizers. So after that, they have spent $12,000 on equipment um, that is used to mix the ingredient uh, for moisturizer. Finally, in March, the business has started and they have sell 100 moisturizers for 50 each. I have to just walk through that how these transaction is basically affected the different statements. So I want to answer this question by using the Excel sheet. First of all, that company is purchased some raw material in January that are moisturizer. Mm, they have purchased 300 units of moisturizer. The price is $1, and the overall amount that is spent is $300. After that, in February, they have purchased 150 units of moisturizer, and basically the price gone up. So the same $300 is spent to purchase 150 units of moisturizer. So if we see, the price is basically went up, and the price is basically went by 100%, because in January we have purchased the same raw material on $1 per unit. Now in February we have purchased these raw material by spending $300, which means that now the moisturizer is cost $2 each. Okay, so after this we have sell 100 units of raw material, and if I talk about this, that this is basically IS2. In IS2 we have dollar of raw material. So now the question is what this cost to the company. So as per IS2, that is inventory, there are different methods for which we can basically value the cost of inventory that we have sold out. The first method is FIFO method. The second is LIFO, and the third is weighted average method. So I'm assuming that we have sold out these raw material of $100 using FIFO method. And what does FIFO method tell us? FIFO method is basically first in first out. First in first out means that we have sold, that we are assuming that we have sold the raw material which we have purchased initially. So initially, we have purchased the raw material that cost to the company per unit $1. So that's why I am assuming that we have sale the raw material of $100 that is cost to the company at the time of purchase at $1 each moisturizer. So now after this transaction, we have some balances. The balances are basically, now we have left out 200 units of moisturizer, which is cost $1 to the company, which almost amount is 200. After this, we have 150 units of raw material that costs $2 each to the company, and the amount is 300. So overall inventory cost is $500. This is basically inventory sheet where I have value the inventory using FIFO method. After that, if we talk about the profit and loss account, as the question said that we have sold out this $100 of raw material by using a selling price of $50 each unit. So $50 each unit means that we have earned a revenue of $5,000. If we talk about the cost of sales, this is basically sales, the $5,000. After that, if we talk about the cost of sales, the cost of sales would be $100, as I have previously assume that as per FIFO method, it would be $100. So the gross profit would be $4,900 to us. So this is the second statement that clarify us that the gross profit earned by the Hoya company is $4,900. So if we talk about the balance sheet balances, there are some assumptions that I have made. The first thing is we have purchased equipment of $12,000. So I assume that these $12,000 of equipment is purchased on credit. So equipment is basically $12,000 at in non-current asset, and we have payable related to these equipment of $12,000 at the current liability section of the balance sheet. After that, in current asset, we have $500 of inventory. As inventory sheet clarify this, that we have $200 of unit $1 unit, and $300 of $2 each moisturizer. So basically, we have inventory of $500 in current asset portion of the balance sheet. After this, we have also have some cash of $5,000, as I have assumed that the sales have been made as cash sales. Basically, I want to write some assumption here. I have assumed that sales are basically on cash. Sales are basically on cash, and second thing that the equipment we have purchased, the equipment is we have purchased is on credit. I have assumed this. Uh, so we have a cash. If we sell these inventory on cash, so we have a cash of $5,000 in our current asset section of the portion of the balance sheet. After that, if we talk about the current liability, as I have mentioned that we have payables related to equipment we have purchased of $10,000. Other than that, we also have $600 of trade payable. So from where it comes, trade payable is basically the payables we when we purchase the raw material. So because we have purchased all these raw material on credit, as it is mentioned in the question, let me share the question with you. As there is mentioned that the 300 moisturizer is being bought on credit, and also the next purchase, which is in February, is also of $300, and it is also on credit. So we have $600 of credit purchases of raw material. So I have mentioned the trade payable of $600 related to raw material. After that, I have mentioned in equity section that because we have started the business and I don't have other information, so I assume that the opening capital is zero, and we have earned a profit of $4,900. So opening capital plus profit less drawing, because there is no drawing. So basically, the closing capital we have arrived is $4,900. So if we total all these mm, amounts, so the total asset is 17,500, and the total equities and liabilities arise at $17,500. So basically, here I have mentioned all the changes in the three statements, that is inventory sheet, profit and loss account, and balance sheet. I have assumed something that is, I have assumed that because it is inventory, so it is related to IS2 inventory, and I have assumed that FIFO method is used to basically the value all these current asset. After that, I have assumed that that sales are basically on cash, and secondly, the equipment is basically purchased on credit. Okay, so now let's go to the second question, second situational question. The second situational question is related to LBO model. First of all, I want to share with you the question. The question is basically there is a company that is, let me share, that is yes, that is Triona company, a medical consultant company, and we have looking to acquire it for 15 times of earning before interest tax, depreciation, and amortization. It has client in US, Italy, and China. Its current revenue is $100, which is spread out between all these countries. The growth is basically 10%, expected growth of basically the sales and other cash flows. It hires freelancer consultant in areas it does business. A consultant are paid in their local currency. Sponsor have historically paid 15 times of EBITDA for similar US based companies. I have to walk through that whether it is a better LBO candidate or not. So, first of all, I want to mention some important points here that we have purchased this company. We are basically acquiring this company by purchasing it 15 times of our earning before interest and tax. After this, the current revenue is $100, and this is basically expecting that these revenue would be increased by 10% growth each year in next 5 years. So, if I talk about the situation that whether it is suitable LBO candidate or not, I have to mention some things that is very important for a company as a suitable LBO leverage buyout candidate. As a leverage buyout model, in leverage buyout model, basically the purpose of LBO is that we have to acquire a company using funds. The fund is basically some portion of it will be dependent upon debt, and some portion will be dependent upon equity. So the high portion is basically the finance of high portion of the purchase price is consist of debt. So we purchase these or acquire these company, and then as a model we develop some cash flows, and basically we have to establish that it is better for us to acquire these companies or not. So the first thing that is very important in cash in LBO model is the suitable purchase price. The first thing that is very important are basically the right or suitable purchase price. That first of all, it is necessary for an LBO candidate that we have to purchase that or acquire this company by a right purchase price. If we have not purchased that company by a suitable or right purchase price, it will cost us, and at the time of exit when we basically exit from this investment, and we have to sold out this investment or this company, so it would be not suitable for us if we do not have purchased that company using a right purchase price. So first of all, it is very important to see that for a LBO candidate, that whether the company is purchased on the right purchase price or not. The second thing is stable cash flows. So it is very important that after purchasing or acquiring a company using some portion of debt and finance, it is very important that there must be a stable cash flows that we have to earn from that company. If we don't earn a stable cash flows, it would not be possible for us that we can earn a better cash on cash return or IRR, internal rate of return, from these from this company. So thirdly, we need to clarify that for a suitable LBO candidate, it must be we have to make sure that we does not need capital expenditure, or huge capital expenditure initially, that called initially. So initially we have to establish that if we need a huge capital expenditure in a company which is acquired, so it would not suitable for us as a better LBO candidate, because a huge capital expenses would affect our cash flows and also affect our returns. So after this, the fourth one is realistic exit. What is realistic exit? Exit is basically that we have to compare the right purchase price and the exit multiples. If let's suppose we have purchased a company at 15 times of earning before interest and tax, but when we are exiting from the investment, so it gives us 10 times, or the exit multiple, or basically let's assume that the exit multiple is 15 times of the equity, or earning before interest and tax. So it would not be a suitable candidate, LBO candidate for us, because the company after the cash flows is not earning as much as we have to. So if we talk about the LBO, the company that is what its name is Triana company. As we have purchased this company at 15 times of the earning before interest and tax, we have to consider all these things, that there must be a right purchase price. If the right purchase price may be established by seeing that what is the exit multiple of this LBO candidate, because here either the exit multiple are not mentioned. So you cannot exactly say that what is going on. The second thing is because the company have a current revenue and there are 10% growth rate over the next 5 years. So we are assuming that the cash flow may be stable and we can earn a great cash on cash return and IRR if the growth is according to the 10% growth rate. And secondly, if the purchase price is less than the exit multiple after the end of this investment or LBO development. So this is basically all these things which I have mentioned in this um, walkthrough. After this, as the third question is also related to an LBO model. Let me. So, in question number three, let me share the question with you. Basically, in question number three, there is a company. This is also related to LBO model. This is a company, Saxa company, a private. Uh, Let me share this. A Saxa company, a private fitness studio brand, and we are basically acquiring this company at 10 times of the earning before interest and tax. Here it is. It the Sexa company is basically acquired on 10 times of the last 12 months of earning before interest and tax of $100 with 6 time debt at close. The company has no net working capital or capex. Company at the initial time has no working capital or capital expenditure. Initially, they don't have. Mm, Secondly, we have put a 10% management option pool into place. So the question is, walk through how you would build an LBO model for Saxa getting me to returns. Okay? There is no need for calculation or crazy mental maths. We just have to basically discuss the high level mechanics of the model. So first of all, let me walk through this. The purchase price is 10 times of last time month, last 12 months earning before interest and tax, that is $100. So it would, if I calculated, so it would be $100 of earning before interest and tax of last 12 months, that is multiplied by 10 times. Okay, so it would be 1000. So this is basically the purchase price. This is the acquiring price or the purchase price or the investment that we have made initially to purchase Saxa. Okay. Okay. After that, the exit value, here they have mentioned the exit value. They have mentioned that the exit value is six times six times of debt. So is mentioned in the question that we have purchased or acquired this company at 10 times of last 12 months earning before interest and tax of $100 with 6 times of debt at close. So, and also we have a management pool option. So, let me discuss different points here. It is important. First of all, we have to consider this as an better LBO candidate by considering all these points that I have mentioned in my last question. That we should choose to consider the right purchase price, the stable cash flows, huge. We don't. The company should not have huge capital expenditure initially, and there should be an realistic exit. So first of all, the purchase price is basically 10 times of earning before interest and tax, and the exit value is 6 times of the debt. So is a company for a company, if it should be better or suitable LBO candidate, and the exit value must be greater or than the purchase value, or you can say that the cash on cash return is basically higher than at the time when we are purchasing that company. So at the time of purchase, this is 10 times of earning before interest and tax, but at exit value, this is 6 times of debt. So I consider that this is not a positive point for this company to be an LBO candidate, because the exit value is 6 times of debt. Secondly, we also have management pool option of 10%, but as I consider the first point that the purchase price is basically 10 times of LTM last 12 months, but the exit value is 6 times of that. So it would not be a better LBO candidate, because this is not a realistic exit that I have mentioned in my last point. in my last point, that there should be a realistic exit or suitable exit. So I would say that the Sexa company is not a suitable LBO candidate for us. Okay, thanks.